All right, good afternoon, morning, evening, wherever it is you are in the world joining us from. We appreciate having you here for our fifth rendition of our book club. We're probably gonna have a little shorter discussion tonight. Figure just given this book, the little book that still beats the market by Mr. Joel Greenblatt, is a pretty much less demanding read than, say, Margin of Safety that we had everybody dig into a few months back. So we've got the whole Wook team here, and I do just want to get a disclaimer out of the way, even though I don't suspect we'll talk too much about individual securities. I do want to make sure everybody is well aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, I just had some spicy Thai food, so I'm sweating over here. We just had a team meeting, so my teammates got to see that. Um, but I did want to ask JP or Joe if you guys could pin. We've got the open mic I posted on my personal account yesterday, and also the book and review for Friday, as well as the summary for the book to the nest up here. And then I think for this book, I mean, given the way it's kind of structured, it's probably maybe easier for us to kind of go around the horn um, and just kind of talk about our own individual takeaways. And then, of course, anyone who's in the audience who wants to come up and chime in, we absolutely welcome that. So while we get the other spaces posted up there and pinned up there, I'll start. I'll be honest. I had never read the book, and it's a really simple but effective book. The the whole idea just hinges on two really basic themes: that high return on capital businesses are high quality businesses, and that when businesses trade cheaply based on their earnings, the magic formula makes a whole lot of sense. I'll leave it at that and invite my teammates to chime in with their thoughts before we bring folks up and dive into it a little more deeply.
Um, yeah, no, I think the concept behind it is pretty simple, which is finding good quality companies that are trading at an attractive price. And I think the methodology might be a bit questionable. So the way he does it is finding company with high earnings yield, right, and a high return on invested capital, and he ranks those companies, and and he ranks it. So, for example, one, like he would rank number one for the company with the highest ROIC, and number one with the one with the highest earnings yield. And when you combine those numbers, the lowest number would essentially proxy for the the cheapest company trading for the highest price. So I agree with the underlying concept, but I don't know. There's a lot of controversy behind whether the methodology still works today. So I guess that's can be left for a different
Yeah, we can get
discussion.
into that, John. Good point. You're right. It's very simple. It had proven very effective in that time. Is it still today? We'll welcome some debate on that. Han,
Right, it's a very popular book. So I mean, this methodology has been back tested by, I'm guessing, hundreds, if not thousands, of people. So you can find a lot of information online on whether it still works or doesn't, and for what reason, or whether it's still valid. So yeah.
good points, John. All right, Han, I'm putting you on the spot. What else do you think about the little book that still beats the market?
It's definitely a very well written book that conveys a simple idea very effectively. Um, there's a lot of humor in this book. I think I've never read a book with more exclamation marks in this one before. So he really, so Joel really tries to, make sure that it's engaging to read for beginner investors, and uses all these examples to explain the idea of earnings yield, and return on capital. And like John said, whether this magic formula works or not, is is a question. We shouldn't just take this magic formula as the truth that'll work forever, but we should look at this with a critical eye. Um, so yeah, I mean, the book does a really good job in conveying those ideas, but I think it's the reader's responsibility to dig deeper into it, um, and look at it with a critical point of view before just blindly trusting and putting all their money into this formula.
And I think the thing that he does well, and if you believe the theme of the book, is that just fundamentally it makes sense, right? The math behind the return on capital or return on invested capital that he uses, your net working capital plus net fixed assets, the capital that supports the operating business. If you have a really high return on that, you're all else equal a better business. It's that simple. I mean, that of course ignores things like sector trends and macroeconomic influences, et cetera, et cetera. But on its most basic level, it makes sense. It passes the smell test. And then on the other side of the equation, the multiple that the stock is trading at, that again, it all else equal, you have a greater margin of safety buying something at a lower multiple than a higher multiple. It's very intuitive, I think, and it makes sense in that regard. Um, JP, what do you think? Anything you'd add to what's been said about the book?
I'm pretty much in accordance with a lot of the things that were said. I think it was a good book. It's a very easy book to read. I like the way he articulated certain things, and he explained some of the very few important concepts in a way where it's like super easy to read, especially somebody without any financial background. Anybody could understand it. So I liked it. But at the same time, I've done some additional research on the book and try to figure out if this thing, the magic formula, is in fact useful and can find alpha and really be something that we can use consistently. But it seems that it may not be able to replicate it as the way that we were able to do it in the past, well, at least the way that the book was explaining. And so I don't know if this strategy is still efficient. But overall, I think it was good. Like, it talked about diversification, looking into big quality businesses, looking at companies with a certain size or higher, and very, very just good read. Yeah, but nothing like, I think the books that we've read previously were more helpful for me, at least. This would have been better if we had covered it like before some of those more complex books, but yeah, it was good.
I agree. It definitely would have been better that we had covered this before Klarman's margin of safety. But
Yeah, and, and it refers to those concepts,
absolutely.
right? Like, yeah. So, but it was also helpful that I knew from that book. So, yeah.
Good. Joe, last but not least.
Yeah. No, I was gonna say I threw out the thread earlier on the Wook account. It's pinned. Talks about the three lessons, at least the three lessons I took away from it, and essentially how his magic formula works, which is a big concept of the book. Obviously, lesson one: evaluate stocks. We talked about this already, based on earnings yield and return on capital. What I found interesting actually is, it says the book talks about picking companies based on these two factors and then ranking them. There's 35 to 100 different companies on the New York Stock Exchange or the NASDAQ, but it would take forever to go through all of them. So I found Joel actually has a website, magicformulainvesting.com, that does the calculations for you. So if anyone was interested in pursuing the strategy, that was the website. It does it, tries to calculate it as best as it can. I didn't get to tinker with the calculator at all, but I would be interested in if anyone has considered the formula, and like if they knew there was just this website out there that'll try and calculate it for you. Obviously, then the third lesson was to be patient. It sucks, but that is the way the strategy should work. And obviously, in the current market, that is probably the lesson that has to be listened to the most, because I can't see this working right now. But if you give it time,
Well, and that's
that's what
it, right?
we're
Like
going
he
to see.
definitely mentions and reiterates multiple times throughout the book. And look, this book was written in the mid 2000s, and when he amended it, post GFC, it was like an afterword from 2010. So it is a little aged, but that point is so vital that the companies are showing up on this list because they're out of favor, right? They've been sold off for one reason or another, and there may be valid reasons. And of course, it's not say I don't think we can get into the discussion. And again, anyone who's in the audience who wants to chime in on the book or the concepts related to the book, please feel free to become a speaker. Request, we'll bring you up. But I couldn't blindly follow the magic formula without trying to do incremental work on it. And I think that in its most simple sense, he wants people. He's not telling people how to do it, but I think he thinks that people shouldn't necessarily tinker. He makes the point, I forget which chapter, that 90 whatever percent of investors should stick with keeping it simple and not overcomplicating it. But those of us that need that complexity in our lives, I think, just going purely by the list. Like I'm looking right now at what the 30 companies that come up from magicformulainvesting.com. So I'm just going to read a couple random names off. This is using a 50 million market cap minimum. I could probably bump it up to eliminate some other junk, but this is alphabetical. So I see a coal company. I see Alpha Metallurgical Resources on the list. AMC Networks, AMCX, which I know has been a favorite of some folks I see in the audience at times. Got some retail on there. I see Buckle, The Buckle Inc., Polished.com, which is they renamed themselves. It was doesn't matter. But I see a lot of bio on there, which is scary. I know that the magic formula is supposed to exclude financials and utilities. I kind of think bio might be another one that maybe shouldn't. But again, I have my own personal feelings that aren't so favorable just because I don't know the industry, right? So I don't touch that industry. But it runs the gamut. Generally, though, if you're on the list, you're out of favor, right? You have a low earnings yield, you have a high relatively probably return on capital, and there's some reason that you've fallen. And the calculator is not going to answer any of those questions. It's just going to give us two very simple metrics by which to try and stack rank different ideas. And I think the nice thing about the book is it is such a simple process that you could very easily, I think, adhere to it. John and Hani made the point that perhaps the outperformance that the backtest showed in the past doesn't hold up, through to today. If you think about the market winners over the last decade, the big tech companies and the like, they probably never would have shown up on the list because they probably never would have traded at a cheap enough earnings yield, based on even in the 2012-ish range, 2011 when they were pretty darn cheap. Maybe they didn't make it on there, but yeah, there's I think there's a lot to be said for just the simple, basic theme of a high return on capital business is all else equal better than a low return on capital business, which doesn't speak to the cost of capital of the business. Just a personal thing, when I worked at Ryder, we know they no longer use this, but Ryder's one of the primary performance metrics for the company and that management worked towards was the return on capital spread. So the return on capital less the cost of capital. So that positive spread, right? Because if your return on capital is less than your cost of capital, every incremental dollar you make, you just destroyed more shareholder value. So cost of capital doesn't come into the conversation much, just the return side. But I think you do need to consider some businesses will have structurally higher cost of capital, whether there's regulatory risks or there's just higher degrees of uncertainty. So the cost of equity is higher. those are things that don't get discussed in the book, but are, maybe like logical next step things to think about, and you can kind of incorporate some of the building blocks, from other readings and in that. And obviously, I'm going beyond just the book and chiming in on that, but if we just leave it on the book, I don't think there's enough to talk about really. So, again, anyone in the audience, if you have thoughts, want to chime in, we're just kind of talking about some of the themes from Little Book That Beats the Market, Still Beats the Market by Mr. Joel Greenblatt. We kind of went around the horn on takeaways. Let me see. So if no one comes up, then I guess I'll put it out to the Wook team while we wait for anyone who wants to chime in. Where, I guess, would you push back hardest on any of what Greenblatt shared in the Little Book? Anything you disagree with him on?
And I would just push back on the timeline of it. I mean, he says there may be a year or 2 years in a row where you lose money, but in the long term, he says you're guaranteed to make money, which I would, it's questionable. That's not, it's a tough thing to guarantee. And there is always the chance that, you purchase this company because the market considers it undervalued. But I mean, you look at companies that the market considers undervalued, and you can look back at GameStop. You can look back at these tickers that we all know and love as retail investors. But for the GameStop example, if Cohen never got involved, sure, the company was incredibly undervalued, but it still, could face the repercussions of short sellers, and it could have gone belly up. And that's why I think his guarantee is a bit much.
Right. That's a great point, because now we live in a world where stock price is so heavily influenced by the mass opinion and the media. So what gets discussed online, or what the general public thinks about a company at a given point in time, can make the price move in directions that are not aligned with the formula. So even if we stick to this in the long term, there was a quote in one of the books that we discussed before that the market will the price will stay sorry, I'm having difficulty remembering the quote, but essentially saying that people can't afford to wait that long, as because the price will stay mispriced for longer than people can stay liquid and wait the long game. So this magic formula, although it directionally it offers a way for novice investors to think about investments and market in general, it's not the most relevant, because you still do have to pay attention to what's getting discussed online, what people think. And like what Joe said, with all these retail investors participating in online there are golden nuggets to be found. And there are also popular opinions that could be totally wrong, that can influence the price and could potentially drive you out of the market.
So let me respond to a couple of those things, because I like what you guys are bringing up. So Han, your point about some people can't wait, that goes back to really, it goes back to many of the books we've covered to date, where professional investors that are managing assets are oftentimes incapable of going against the herd because of fear of underperforming their benchmark or their peers, losing capital to outflows, to redemptions, whatever. And that their capacity to hold 3, 4, 5 years and wait for fair value, or the equity to trend toward fair value, is not there. They just can't do it. And the individual retail investor has that as an advantage. The other thing was, and I listened to David Einhorn had a podcast with Patrick O'Shaughnessy, came out yesterday. I listened to it today, and he kind of made the point that, at least in his view, equities are no longer even kind of comporting to fair market value. They're, what's undervalued is staying undervalued. But I think his notion that he shared in that is effectively, well, look, that's where capital allocation, if they're going to buy back 20% of shares outstanding this year, 15% of shares outstanding next year, if the earnings yield is there, the capital allocation approach is there, eventually the company is going to be buying itself, private or close to it. So, those things, of course, unloved stocks can stay unloved for a long time, but I think there's some power to the reality that money talks. And if you're generating meaningful free cash flows, you're allocating that capital effectively and over a medium to long-term duration, it's hard to argue with that. And you're going to grow free cash flow per share, and the market should eventually reward you. But I think it is valid pushback, right? The market hasn't really rewarded those things that well on net relative to some of the most speculative stuff for a while now. So I can understand his Mr. Einhorn's frustration and the reality that not everyone can wait.
Yeah, and I mean, just because something's mispriced doesn't mean that the market is going to price it effectively sooner rather than later. I mean, people that opened Tesla shorts 5 years ago probably felt like this thing was going to plummet, in the next few years, and it's taken a long time for the reality to settle in. So
I know.
you can't.
I hate to really poo-poo Tesla. I think Tesla has taught many investors the worst of habits because I think that Tesla was rewarded for a lot of the wrong reasons, in my opinion. And unfortunately, I think a lot of people think everything is the next Tesla, and I don't know. I just struggle with that notion, because yes, it certainly overcame a lot of odds in growing into something that sort of resembled the valuation, although again, it's gotten crazy. But growth is always something that's tough for folks like me who are value-oriented investors at heart. Nvidia right now today is another one it's like we all know that AI is clearly a very, very disruptive technology, possibly the most disruptive technology of our lifetimes. We'll see if it's more so than the internet was here when I was born, but it certainly wasn't ubiquitous until later in my youth. But AI again, Nvidia, everyone is buying the stock purely. I think many, right, because it's AI, just like many people are buying Tesla because EV. And I just worry that sometimes people, if you get lucky, maybe. And I think I've noted, right, we talked about this in the last book club, how a lot of what happened with GameStop was certainly luck more than anything else. And acknowledging it and recognizing that is okay. But I think when people do see kind of these generational type things play out, like what Tesla has done so far, that I just worry that it ingrains bad habits in investors. And I feel like I've seen a lot of that over the last few years where people just think it's normal for an equity to appreciate 5-10x in short order. And it's not normal. Yeah, I hope I don't sound like too much of a curmudgeon.
I think if we're taking the assumption that it doesn't work today, I think it's worth discussing about why, right? Rod, I'll take it to you, put you on the spot. Why don't you think it doesn't seem to hold up as much as he claims in the book?
Yeah, I think it gets back to the point I was making, that Einhorn is making, that the way market participants opt what to own, a lot of them, right? They're buying ticker, whatever. They're buying a company that fits a factor. They're buying a company that's in a sector. They're less interested in knowing the fundamental fair market value of the business. They're much more interested in where do they think the business is going to be priced based on short-term stuff. So the market is clearly more short-term oriented, right? We've all heard the large mix of zero data expiry options and very short dated options. So you have a lot of market participants that are very short-term oriented, and it certainly makes it difficult for someone who thinks they're going to find an undervalued, high return on capital, high earnings yield company that they can just buy it and eventually it's going to re-rate, or it's going to reward them through cash return 5 years from now. Because that cheap stock, it seems like the cheap stocks can stay cheaper for even longer, I guess, than when Mr. Greenblatt wrote this book. I would kind of agree with that notion. And the expensive stocks can stay expensive for years and years and years and get even more expensive on the other hand.
Yeah, I agree with you. Um, I think there's like at least four reasons why it might not work today. Uh, I think number one, he's lying, but I don't think that's the case. I think everything he says is true, and you know he's a legend in the industry. So everything he says in the book, the numbers that he gives, I think are correct. But today, if I had to think about why it doesn't work, I think one potential reason is that too many people are doing it. I mean, if you already look at like research on the magic formula, there's already hundreds of articles back testing this, seeing if it works. And if you look at majority of them, they'll tell you that it doesn't, right? And it's not that hard to do because essentially his strategy is just taking two numbers and no due diligence and expecting it to beat the market for a very long time. Another thing that I think that's problematic is his 1 year holding period. I think Joe mentioned it earlier. And the whole point of investing in high return capital companies is to let them compound, right? If you find them cheap. But then he rebalances the portfolio every year. And I think that's less likely to work, you know, in the very long term in that case. Another reason is when you find these companies, especially today, based on two metrics that are cheap and at a quality company, as he puts it, through high ROIC. It's usually cheap for a reason. I tend to believe that the market is fairly efficient. So, you know, more likely than not, the future prospects aren't great, and those numbers are there for pretty good reasons usually. But to his point, that's why he does it through a diversified basket and does reset every year. Another one is, I mean, we've been in a market that's been chasing growth stocks for I don't know how long. It must have been at least, I mean, over a decade for sure, right? And he himself says that his value stocks don't do well during that period, no matter how long that takes, and will eventually pass fundamental value. I don't know if that'll happen, if that method will still work, because that sometimes takes decades. Um, but I guess my whole point is just trying to say that I don't think there's a shortcut to buying this Buffett style of finding cheap companies for with very little work. It takes hundreds, if not thousands, of work, which has to be verified both quantitative and qualitative evidence. Unfortunately, but I mean, overall, the book, the underlying concept is so good, though, right? The whole point of value investing is find good quality companies at a very cheap price, because that no matter how much the finance industry evolves, I mean, you'll finding cheap companies for a good price, that'll always make sense, no matter what.
And then your cheap stocks just get cheaper and cheaper. The way of the value investor. Hey, again, anyone who's listening in, we would welcome anybody to come on up and chime in what they think about the book or any of the themes we are discussing. So, last one alive. Let me bring you up. It won't let me. I see requested. If you're joining from an Android, I'm worried that could be the problem because Mr. Musk doesn't like Androids. I tried to add you and it gave me the spinny wheel. So I don't know if it's going to work.
Just to respond to what John said. So I think this book is so easy, and it focuses on making sure that the reader understands what the magic formula is, and just pushing that concept to people. So I think it's often it's easy to kind of get trapped in that mindset, and seeing things black and white. Does the magic formula work or does it not work? But I think it would be a better approach to take it as a grain of salt, and really focus on the idea that it's important to keep in mind the most basic fundamentals of investment, which is finding good companies and making sure you buy them at a low price, as John explained, and thinking about how we can best stick to that core idea, and then invest freely, but then not only just kind of like rely on the magic formula, but think about what we can do to always pay attention to the core objective of investment, and kind of also staying flexible within that frame.
I mean, they're very like axiomatic things, right? All else equal, a higher earnings yield is better than a lower earnings yield. All else equal, a higher return on invested capital is better than a lower return on invested capital. I think those two like very fundamental things. I, I would say it's hard to find much argument with that unless we're going to go into like nuanced particulars, right? John, you wanted to chime in?
Oh no, I had my mic
Okay.
on by accident there.
Yeah, sorry, last one. I'm not sure why I keep trying to bring you up. I guess it's the Android glitch issue still going on. But if you're on an iPhone and you want to come up and chime in, you're welcome to. We do plan, I think, on exploring other platforms. Unfortunately, this platform continues to deteriorate, we've found. So, we'll see. We're going to keep posting on Twitter, but definitely want to keep other options open. If unfortunately the platform is unusable, so be it. But okay, so let's see what else with. So I think like the reality is that in 1 year, 2 years, even 3 years, right? Like a cheap stock, a high earnings yield stock that also has a high return on capital. I mean, it very easily could remain undervalued, and I think that's where we're, I guess, maybe pushing back on Mr. Greenblatt's notion that it will yield a good return, or it will get to a fair value, because clearly, again, in this post GFC world where growth at all costs and low interest rates have kind of been the name of the game, that has not maybe held up as much as it did when he wrote the book. It'll be very interesting to see, right? We talked about Mr. Mark's memo about the sea change in interest rates that he's observed. And even though maybe mega cap tech is still hooked on the drip of ZERP and hopeful that we go back to it, it seems like broadly most are not of the view that we return to anything that resembles zero interest rate policy in the near term or medium term. So it'll be interesting to see as interest rates remain a little higher than they had been for the past decade and a half, if this book's, this theme or this thesis starts to hold more true that like it did in, when Mr. Greenblatt backtested in the 90s and 2000s. What do you get that? What do you guys think? I mean, my gut is that yes, value should outperform growth in this normalization, all else equal. But perhaps growth will just never ever stop, and Kathy will become the world's first trillionaire.
I would love to see that. But yeah, I think it keeps going back to the notion of so just to go back to our other book club discussion. Richer, Wiser, Happier covered Joel Greenblatt and his story, and there were 4 lessons from Greenblatt, and they basically say that strategy should be simple and logical, that you understand it to your core and stick with it even in the most difficult times, when it no longer seems to work. So it's interesting that, now that we think about what we're going through now, it's obviously a market environment that doesn't give much confidence to the investors. And Greenblatt is saying that we just need to make sure that we have the mental firepower to go through this and have like a blind, um, trust in the magic formula in a way. I personally, I agree with his approach of staying true to the core strategy, whatever that strategy may be, and really starting with the same frame when you look at companies, but still blindly following the formula. Like John said, there are so many people online who have back tested and gotten varying results. So we'll have to, you know, look at it with a critical eye and be careful on what we do with the formula.
Yeah, he actually recommends it very literally. Actually, he even has a website where you can sign up and he screens the stock for you. I haven't signed up because I think you have to pay.
No, it's free. I'm on it right now.
Oh, is it really? Oh man, I think I was just too lazy to make an account
Yeah,
then.
so like I'm
But then,
looking at a lot of the companies, that's what I was saying earlier. A lot of the companies, I bumped the minimum up from 50 to 300 million to make it a little larger, but I can see a handful of coal companies on there. I can see a bunch of medical and bio related companies on there, some other energy companies, a automotive component supplier who I do not own, but who I have followed for a few years now, who is very interesting. HP is on there, so it kind of runs the spectrum. But again, these coal companies, just from a earnings yield perspective, is probably what's making them rank so highly, right? They have extraordinarily high earnings yields, and since it's just a trailing earnings yield, right? It's just a snapshot in time, and I think that's one part of the book that is important to emphasize. Normalized earnings are what the investor should be seeking to analyze, and of course, all of us are going to do our best, but it's very hard to know what the future looks like. But I think that's where stocks could show up on this by virtue of very strange market dynamics. And the coal stocks obviously have over earned. In the past, they're going to continue to earn well, so it makes sense why folks may want to be invested in that space. But from a quality, those are commodity businesses, right? The ROIC is not anything magical. So I see why those companies are coming on, here, because they're trading at such extraordinarily high earnings yields, but they're not the most high quality companies. And then when those earnings yields normalize, perhaps they won't actually outperform the underlying index. Who knows? But just what I'm seeing when I look at the magicformulainvesting.com screener right now.
Sorry, guys, I got to drop for an urgent call, but thank you for the discussion. And yeah, I'll talk to you guys later, and I'll catch up with the recording. Thank you, everyone else, for listening. Hope you guys have a great discussion.
See you, Han. We're going to distribute the balance of year readings, by the way, in our Friday newsletter. So if you're not currently receiving that, you can just click the little newspaper icon in the Wook Capital handle and just open up the profile. You can click in there and you'll get a free short weekly Friday morning newsletter in your inbox, and it'll have the forthcoming readings. Again, just a programming note, we host these on the last Tuesday of every night at 8 o'clock Eastern. Our intention is to have at least 7 or 8 more to the balance of the year. We'll see what the scheduling permits precisely, but we do have the list ready to go, and we'll be distributing that Friday in the newsletter. So be sure you're signed up for that.
Roddy, we have a write-in comment from last one. Maybe you want to read that and
sure.
go over it for us.
Okie dokie. Yeah, it's not really relevant to the conversation. We're not really talking about short dated um, trading in this, but I will take a peek at it afterwards. Um, yeah, I mean, look, that's obviously this space is a different setting, I guess, than like some of the more. Oh, I guess last one is able to come on up now. So yeah, go ahead.
Yeah, I just dropped that in the comments if anybody want to check it out. Those are like if anybody wants, like I don't think a lot of people understand how ODTOs really like influence the market. Like those show you like if you go to that web page and you go to the second graph, they show you all the live ODTO options on the spies that are generated that day, and it changed throughout the day. And if you notice like if you notice what the highest call sold and the highest put is about 70% of the time, especially when it's low volume, even more than that, when it's low volume, the market maker usually ends up in between those two, between the highest and calls. I put the graph on there. You can see like when it went above the highest call, they brought it down. When it went below the highest put, they brought it up, and and they keep it around there. And
So you're talking about
and
0 day to expiry options. We're talking
well,
about an
what I'm
investing
trying
book club discussion. I'm just trying to understand where
no
the
what I'm
connection
trying to show
is.
you, what I'm trying to show you, like the zero DTA options kind of like influence the market a lot. Like they're kind of like they have a huge influence on the market. So it's kind of hard to like find price discovery nowadays because they influence the market. So on a day to day basis, and then overall they influence it too. Like overall. So I'm just point that out, and you can go back and look at it for like the last 3 weeks, and and it's the same pattern. Like they'll end up within the call and the put, and I'll just point that out just to let people know that so they can
Okay.
take that into their calculations when they're when they're trying to understand why things go up or down, or in the market if it don't make sense. All right.
I think the nice thing is for folks with a long duration view, it shouldn't really matter if things go up or down in the short run, right? If you're buying an equity with a ownership mentality and thinking about the cash return of the business, the cash generating capabilities of the business, the intrinsic value, right? Like yeah, all that like short term price action is in a whole lot of noise. I mean, I can appreciate where you're getting at that, understanding, I guess, dealer positioning and what is on the option chain and yada yada. If you're trying to do day trading, right, then yeah, you should be aware of those things. But from an investor's, you know, lens, those are probably less important areas of focus.
Do you really think fundamentals ever going to come back to the market?
Yeah, I don't invest based on short-term price movements personally. I think that while the themes in the book are not absolute, I think over a multi-year duration, broadly, all else equal, investing in businesses with high earnings yields, high returns on capital are going to outperform just a passive index approach. But to each their own.
So, but so let's say the Fed does more QE, lowers interest rates. Do you really think fundamentals are going to dictate the markets?
If the business I'm invested in is able to grow free cash flow per share, that in the long run is far more important than whether the Fed hikes again or pauses or does decide to cut like the equity markets and or rather the rate futures markets are pricing. Like those things are all, again, if you're doing short-term trading, those things are very important to get right. But if you're buying an equity and you're dollar cost averaging over years into an equity at levels you deem attractive, then I don't think those things matter at all.
Yeah, I agree with you.
But look, we'll talk some different trade ideas in our Friday Wook and Review. As we've mentioned a couple times now, we have a watch list that we've gotten put together, and several of those companies have had some major news this week, so we'll definitely dig into some more short-term oriented discussion. But again, for kind of the purposes of this, we're kind of talking about the themes from Greenblatt's little book that still beats the market. And yeah, it's definitely, I don't think Greenblatt espouses any duration really under, I think really 3 on the low end. Granted his process is got some quirks to it, but hey, Dean, you want to chime in on it?
He's still connecting.
Oh, he dropped. Okay. I see some regular faces in the audience, and don't be too shy, guys. You're all welcome to chime in. Dean, you were up as a speaker. I don't know if you got booted. I'm going to invite you back up. Oh, you're requesting. Let's see if that'll work the second time. Go ahead, Dean.
Can you guys hear me fine?
Yep.
All right, perfect. Sorry, my headset was being a little wonky. But I had one question about the book. So I was just curious if Joel's magic formula doesn't work, what should I be looking at to find value stocks instead?
If his formula doesn't work, what should you be looking at instead? Look, I think the components of his formula are a very reasonable place to start, right? High earnings yield, high return on capital. I mean, I think the return on capital part is where people kind of broadly would agree that all else equal, higher return on capital is a higher quality business. And there's the caveat here that this is tangible capital. So if a company's been awfully acquisitive and there's a lot of goodwill on the balance sheet, and that calculation would say it would communicate a lower return on capital than maybe the true operating business is able to generate because it's burdened by that non-tangible asset, the goodwill from the acquisition. I could think of, for example, British American Tobacco, a company that I own in my personal account. It has a very high earnings yield, but it might not screen so well on the return on capital side. Right now, the trailing return on capital, just pulling the Coifin calculation, just shows 6.45%. However, I know that they made a very large acquisition about 6 years ago that if you back out that goodwill, the math would look a whole lot different. So I guess to circle back to your question of if Greenblatt's formula doesn't work, how would you find value stocks? I mean, I think simple screens like the formula are a good way to find companies worth digging into more. Those metrics are good ones. I really like the earnings yield, right? What is the company paying in free cash flow, or what is the free cash flow per share? Obviously, then you can consider the debt burden of the company. You consider whether the free cash flow to the equity versus free cash flow to the firm. I mean, we can get into like the weeds, I guess, on that if we want, but I think that the formula is actually a very good place to start to find value-oriented stocks and stocks that are attractively priced or maybe attractively priced. John, where else would you start?
I mean, there's no one way to do it, right? That's what makes it so hard, and that's the biggest challenge. But to your point, it is a good place to start. But more often than not, if those numbers are there for that reason, I'd say there's usually a pretty good reason. And then once you dig into it, you'll see why it's cheap, because the market is fairly efficient, as I mentioned before. But really, there's no one way to do it. I wish there was a simple answer. I wish it just as much as you. But it could be anyway. I mean, different investors advocate for different ways. For example, Peter Lynch loves to look into products that he really understands and knows, and then and starts from there, for example. But in general, I'd recommend staying within your circle of competence. And I'm sorry I can't give a more specific answer because there it really isn't one. But if we're being relevant to the book discussion, I definitely say it is a good place to start. But even within that pool, the pool of stocks that you'll screen from Joel's method, it'll be pretty tough to find even one from there.
All right. Well, thank you guys. That was really insightful, and I appreciate the space.
Thanks for chiming in. Again, anyone else in the audience wants to chime in, please feel free. Kind of figured this would be a shorter space. There's just only so much that can be said about the little book, which it really is just a quick, really good refresher, though. Even if you're experienced investor, I think this is the type of thing that every several years to go back on some of these more foundational type, simpler reads and just kind of make sure that things still click. I know, Ben, you've been listening, so would love to hear what you have to say.
Yeah, so I didn't read this book. It's my first disclosure here. But I just kind of went over the cliff notes from it. Does he specify whether or not this still applies in like a higher interest rate environment? Because the one thing that just kind of sticks at me as like a potential issue is that he goes off of EBIT, which obviously involves interest. And depending on the company, the investment, the style of debt that they have, that could be an issue maybe with that formula.
Yeah, it's a great point, right? So I think just for the sake of anyone listening, right? Why is he going off of EBIT so that the variations in local tax authority, in capital structure, how much debt burden the business carries, it's more of an apples to apples operational comparison as opposed to a true comparison of what the real reality is. So that's a great point. The book was written, I think the first one came out in 2006, Ben. So this is a pre-ZERP book. So he refers to using 6% as his risk-free rate for the 10-year in the book, which again, right, we didn't even get to 6% in in this recent cycle, assuming that the high is in on the 10-year. But yeah, no, it's a great question, and it is something that you need to know as an investor, right? This company may have a fantastically high earnings yield, but they may be burdened by some really expensive, cumbersome debt, and that I in the EBIT is a real cost for them. But I get why his logic is to use an operational comparison, and he uses EV to EBIT, right? So the earnings yield there with the EV calc does account for the debt.
That's fair, and I didn't realize it was from 06. Oh man, but I would just say on that kind of note, it's always a really good idea to go back over the debt docs of anything that you're invested in, because even though Cov Light was super popular over the last decade, you'll still find some really weird shit in debt docs that have to do with like weird step ups or things that can, and I'm not a credit expert by any means or a debt expert by any means, but I always just encourage people to do that, because like it might say that it's like fixed rate on its face, but then like you go deep into that debt doc and you find like weird step up conditions if SOFR goes over a certain thing, or actually it was LIBOR, I guess, at the time. But if LIBOR goes over a certain rate, then there might be a step up involved. Stuff like that. So I just always, especially in the current environment, I encourage people to brush up on the debt docs of their bigger investments and make sure that's it's all squared away.
Yeah, without a doubt. Highly leveraged businesses, a lot of them are understandably at a lot of risk right now if they're not, if they have near dated maturities, if they're not going to find themselves able to refinance their debt on attractive terms or at all. It's definitely not nearly the end of the bankruptcy and restructuring cycle as I see it. I think that we have a ways to go through that, even though we've, of course, seen the few bank failures. There's a lot of still, zombie-like businesses out there who the operating income that they generate doesn't even service the debt, for example. So Yep, there's going to be a lot more restructuring. Distressed debt investors like Mr. Howard Marks, I'm sure, are licking their chops. They probably hoped that the Treasury, the FDIC, and the Fed hadn't been so prompt in their blanket uninsured deposits coverage, but perhaps they'll just have to wait a little bit longer. Ben, how do you find value stocks?
Whew. That's a great question. I have several screeners in place, but the main thing I'm kind of looking for at this point is GARP, I guess. I mean,
Growth at a reasonable price.
I'll start. Yeah. Sorry for anybody who didn't know that one. I don't think that we're still at the point for me, for our little nobody shop. I don't think we're yet at that inflection point where I'm going to start like running value screeners every day. That's just, and there's so many value traps out there. There's the reason I'm looking at GARP versus, again, like straight value or deep value is just that, one, the whole space is just filled with value traps that, in my opinion, are probably not going to survive. And with the amount of companies out there right now, they're kicking out huge dividends. That's most of our longs right now, is kind of weird, energy, coppers, a few very select and defensively positioned REITs that all kick out like high single digit, low double digit yields just on the div, and are, trading around book, tangible book. And then GARP, because I don't think that, we're going into a deep recession or anything. But I don't think we're at that capitulation point yet in the market where people are going to start really looking at growth, or value as like a, like on an actual return basis, like something that makes a lot of sense. Right now the market is still trying to front run the pivot and, buy the dip in growth names. And as long as that keeps happening, value is not going to have its day.
Yeah, it's pretty incredible. The Nasdaq's up 15% year to date. The Dow's down 2%. S&P's up 3%.
And just as an example, Micron posted one of their worst quarters in history and is flat after hours. That tells you a lot, I think, about the current environment. I mean, on the call, the CEO said that we're experiencing the worst downturn in semis in 13 years. And the stock's flat. So, like, I think there will definitely be a point where, and we have like a shopping list kind of already in place, and that could change depending on what changes in the global economy. But I'm not running the value screeners yet on a consistent basis, at least. Because again,
what do you
there's
look
not
for
been any real capitulation
in a GARP type screen? What's reasonable and what is quote unquote growth in your view?
So an example I would give of this would be this company called DotGo. I've been talking about them for about a year now. The ticker's DCGO. I still have this huge unfinished deck that I'm going to be submitting to somebody, but so those guys it's a novel business model for one. Not that nobody else can get in there and do the same thing.
So this was a
but it's a novel
healthcare
business,
de-SPAC,
right? And so because people always like, oh, how'd you find this thing? I might say I found it, sifting through a pile of dead bodies, all the de-SPACs. I found something with a pulse in it. It was trading like $5, and they recently redeemed all their warrants, which is the absolute number one thing that you want to see in a de-SPAC. I mean, just from a value perspective, obviously you want to see that because they're just kind of staving off future dilution in a way. But they recently redeemed all their warrants, so they kind of got that de-SPAC stink off of them, and they've just consistently beat and raised every single time. We trimmed a bunch because we basically just rode that thing up almost 100% and wanted to take the W. We put a little bit back on recently, but again, we're afraid that it's going to get flushed out with everything else this year, so we're kind of just waiting for now. And it is pricey, obviously, on its face, because they do, and I think it's a bad decision on their part. They kind of slot themselves in as more of like a tech company than a healthcare company. But they are kind of in that, they did find a great little niche in that, kind of home healthcare, telemedicine. They do a lot of home-based stuff too, but kind of like telemedicine. And they're basically an outfit, like they can show up at your house. Like say your kid this was an example the CEO used recently in an interview. He's like, okay, your kid is sick at home. They have like a sore throat. You think it might be strep. So we have one of our doctors come out and they will diagnose and then prescribe on the spot. So you don't have to drag your sick kid to a doctor's office for 3 hours and deal with that. And I think that will appeal to a pretty decent part of the market just as a concept, not having to drag a sick kid to a doctor's office. I'm not a parent, but I remember being a kid, and being a kid was strep.
It's interesting. So I'm reading, I guess, a little bit about it. It sounds like instead of pure teledoc or telemedicine, it actually is like a last mile mobile come to you doctor or paramedic or whatever the medical term is.
Yeah, definitely not paramedic. That's a whole different can of worms. But yeah, no, they are. Yeah, it's like last mile. It's not even. I wouldn't even say it's last mile. It's kind of like a one-stop shop for most things that you would go to, like an ER for, or like a GP. So it checks a lot of boxes for like what most people need healthcare for. And again, they just keep beating and raising like so many quarters in a row. It's kind of that was kind of what caught me off guard when I first found them too. Just them consistently beating on earnings, and I could not detect a single line item of fuckery in the accounting, which is also something I always look for. So yeah, to me, like that's GARP. Like it's still kind of pricey at the current. I think it
was forward was 29 right times forward earnings.
Yeah, that still makes. I mean, that's hardly even GARP, right? But they at the same time, like they keep kind of growing into that by beating and raising guidance. So like, and they keep securing new contracts.
So Ben, if you like the medical space, I'm thinking GARP. Something that might fit that definition, maybe that's a little bigger that people might know about, might be like Danaher right now. I don't know if you know them or if you
Danaher Scientific.
Yeah. Well, Danaher Corp.
I haven't checked on those guys in a while.
Right now,
what are they trading at right now?
Forward PE is 24 and at 24.7, and the forward EV/EBIT is 24.6x.
That's not bad. That's about in the same bucket.
I just know they're 180 billion market cap, so I figured more people would know about them.
Yeah, and like and I'm kind of more afraid of the bigger healthcare names right now, only because like kind of part of like our macro outview is that or outlook is that with all the white collar layoffs going on, and this also applies to DocGo, unfortunately, people will be losing health insurance because these are obviously mostly white collar layoffs.
Right, the end of this month, right? The Medicaid extension
that
collapses.
too. Yep. So you will have people. I don't think DocGo works with a whole lot of Medicaid. I'd have to go back through and read what their exposure is like with that exactly. But yeah, so you will have people losing access to healthcare. That's just going to be an unfortunate reality. And that also is why we're not like, super long the stock. We kind of want to see how the whole thing shakes out first.
There is an alternative.
Yeah. So, I mean, I still think copper is also certain copper names kind of fall in that bucket right now. And I've been like, saying how bullish I am on
secular trend is just irrefutable. It's you just cannot argue that copper will be in huge demand in decades to come.
Yeah, and I was, this week we've had Goldman Sachs, I can't say the name.
Trafigura, I don't know how to pronounce it.
That sounds good enough to me. Um, but yeah, we've had all these kind of big reputable shops coming out this week and making these really bullish copper notes, and that felt good because I was basically pumping the copper along about 8 months ago, and saying that everyone had that everyone had copper wrong in this cycle, because in this cycle we have this huge ESG tailwind on top of EVs, everything else, and I went over the GS note. And a lot of people said it was a little too pie in the sky, too optimistic, but their numbers actually, especially when you go into the EVs and the wind, they were very conservative on their tonnage.
Yep. All right. Well, good. Appreciate the thoughts. And look, I think the Cliff Notes version of the book will get you most of the way there. So if you skim that, you walk away with a solid enough understanding.
Yeah, I really like the concept. It really, I'm definitely going to be using it.
Yeah. Good. Well, look, it's 9:10, so I'm going to kind of open it up for my peers if anyone on my team had any last thoughts, or if there's anyone in the audience who wanted to get any other thoughts in, and then we probably wrap it because I don't want to go stray too far away from the core book discussion. And Ben, I hope we talk later. If you're around tomorrow night, we'll have our open mic from 7 till whenever we wrap it. So would love to talk more copper then. But any last thoughts, John or Joe?
No final thoughts. Just if you're a Wookiee, keep your eye out for the book list. We're gonna try and get it out soon, and gonna have some other updates soon as well. So just stay tuned.
Yep. Thanks, guys.
Awesome.
Really appreciate you.
All right, great. Well, let me just then wrap it there. So we'll be back with our open mic series tomorrow night, 7 p.m. Eastern. I'll be hosting that under my personal profile, which I have in the room listening, at Rob Alsman. You're welcome to give me a follow if you'd like. Give the Wook Capital handle a follow so you don't miss any of our updates. Again, Friday morning, we'll have the newsletter out. We send these out weekly. We're never going to be charging you a fee for that, so don't worry about getting heckled. Just click the link in the Wook Capital handle, and the little newspaper icon will bring you there, and you can be sure to receive that. That'll have the final book club list for the balance of the year. This was our 5th rendition of our Wook Book Club. We'll be back next month, the last Tuesday of the month at 8 p.m. Eastern. And otherwise, we'll catch you on the Wook handle Friday at 4 p.m. with our Wookin' review. Thanks, everybody, for tuning in and participating this evening. And we'll talk to you soon. Cheers, everyone.
Cheers.